Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Today we're sharing three stories. First, activist investor Carronade Capital is pushing for a spin-off at Viasat, claiming its hidden defense business alone is worth double the company's value, potentially unlocking a 304% return. Second, Federal Reserve Vice Chair Michelle Bowman is publicly breaking ranks, calling for aggressive rate cuts after the Bureau of Labor Statistics reported a shocking 35,000 new jobs per month. And third, how a Chinese app called DeepSeek R1 triggered a staggering $600 billion loss for Nvidia, a shockwave Mark Andreessen called AI's Sputnik moment that challenged OpenAI's entire model. An activist investor is claiming one misunderstood tech company holds the key to a potential shareholder return of 76 to 304%. The company's Viasat and the investor Carronade Capital says the market has its story completely wrong. Wall Street sees a legacy satellite company with its stock down over 50% in the last 3 years, marked for death by new high-profile competitors. So the thing is, the market is often driven by powerful stories. And right now, the narrative is dominated by competitors like Starlink. Research shows that a compelling story, especially one led by a high-profile figure, can create what's called a narrative premium, causing investors to overlook the solid financial performance of established players. That legacy business is in fact stronger than it looks. For example, in its in-flight Wi-Fi business, switching an entire airline fleet to a new satellite provider is incredibly difficult. It involves massive costs, with new terminals priced at $150,000 each and a complex, lengthy FAA certification process for every plane. This creates a powerful protective moat around Viasat's existing contracts. But Carronade argues that's not where the real value lies. Buried inside Viasat is what they call a hidden gem. It's Defense and Advanced Technologies business, or DAT. This is where the situation takes a more complex turn. This isn't just about standard military contracts. The DAT unit is developing next-generation technologies that are truly groundbreaking. One of these is a direct-to-device, or D2D, platform. This technology allows a standard, off-the-shelf mobile phone to connect directly to a satellite, with no need for a cell tower. For military and government clients operating in remote or disaster-stricken areas, this is a game-changer, providing reliable communication where none existed before. It's a capability that many competitors simply cannot match. Now, get this. This defense unit boasts best-in-class EBITDA margins of 28% and double-digit revenue growth. While its direct competitors trade at valuation multiples as high as 80 times EBITDA, the entire Viasat company currently trades at just 6 times. Carronade's analysis suggests the defense business alone could be worth up to $16.2 billion. The entire company's current enterprise value, just around $8 billion. That's right, one part of the company could be worth more than twice the whole thing. This points to a classic case of what investors call a conglomerate discount. The market sees one big, complicated company and struggles to value it correctly, so it applies a discount. The negative story about the consumer satellite business is dragging down the valuation of the incredibly profitable defense business. By separating them, you remove that discount and allow the market to value each part for what it's truly worth. The proposed solution is simple but compelling. Spin off the DAT business. Let it trade on its own, free from the negative sentiment dragging down the satellite segment. Carronade believes this single move could unlock that massive shareholder return. Management has already signaled they have been considering selling some of the defense business, suggesting they may already recognize the value proposition. This is now a battle between an old market narrative and a new explosive valuation. The only question is, will this hidden gem finally be brought into the light? All stock market information is subject to change, and this report does not constitute investment advice. Speaking of market narratives that might be missing the bigger picture, a major debate is brewing inside the Federal Reserve, and it's sending shockwaves through the markets. Federal Reserve Vice Chair Michelle Bowman just dissented against the central bank's decision to hold interest rates steady. Now, she's doubling down, calling for 3 aggressive rate cuts this year. So what's fueling this dissent? A startling new figure from the Labor Department. Job growth has cratered to an average of just 35,000 per month over the last 3 months. To understand that number, you have to know how the Bureau of Labor Statistics, or BLS, gets its data. It uses two massive surveys. One calls up about 60,000 homes, and the other gathers data from about 120,000 businesses and government agencies. The key detail, though, is that the first number is always preliminary because not all the data is in yet. It gets revised later, which is a source of huge debate among economists and policymakers. To put that in perspective, economists say the economy needs to add around 100,000 jobs a month just to keep things stable. We are falling dramatically short. This brings up a crucial debate. Are these numbers designed for a pre-internet economy, even capturing the full picture anymore? How well do they measure the gig economy, remote work, or people with multiple side hustles? The big question is, are we making policy with an outdated map? In a direct challenge to the Fed's cautious majority, Bowman said failing to cut rates now risks a further erosion in labour market conditions. She argues the time for waiting is over and the Fed must act proactively to prevent a serious downturn. This isn't just an internal policy dispute either. The disagreement inside the Fed actually goes deeper, down to the very tools they use. The Federal Reserve uses incredibly complex computer models to forecast the economy, like their main FRB US model, but different Fed banks also have their own models, and these different systems can have different assumptions baked in. So two officials looking at the same data can come to wildly different conclusions about the future, leading to exactly this kind of public split. It's a high-stakes conflict playing out as the Trump administration pressures the Fed for easier policy, and a search for the next Fed chair is already underway. Bowman is making it clear that the risks of an economic slowdown have now eclipsed the risks of inflation. She believes underlying inflation is already much closer to the Fed's target than official numbers suggest. Believe it or not, this is where cutting-edge tech comes in. Some experts believe we could get a much more accurate, real-time picture of the economy by using AI to analyze data from private sources like payroll processors. This could prove Bowman right that the official government data is just too slow to capture what's happening on the ground right now. Is Michelle Bowman a lone voice sounding a premature alarm, or is she the first official to signal a massive policy pivot that could change the direction of the entire economy? The next Fed meeting just became the most critical one of the year. We were just talking about the complex models the Fed uses to understand the economy. Now, let's shift to a different kind of model, an AI model that just triggered the largest one-day loss for a single stock in the history of the US market. The company was chip giant Nvidia, and the loss was a staggering $600 billion, wiping out 17% of its value in hours. What really brought this to a head was the realization of just how fragile AI market valuations have become. Investors weren't just reacting to a new piece of technology, they were reacting to a story. A story that suggested the entire high-cost, high-end chip-dependent model that made Nvidia a titan could be disrupted overnight. It was a classic case of fear and narrative overpowering fundamental analysis. The culprit? An artificial intelligence app called DeepSeek R1, which exploded overnight to become the most downloaded free app in the United States. Venture capitalist Mark Andreessen called it AI's Sputnik moment, kicking off a new phase in the tech Cold War. And calling it a Sputnik moment is no exaggeration. Interestingly enough, this framing is incredibly powerful. It allows both tech companies and policymakers to cast the AI race as a matter of urgent national security. This narrative has been used to justify enormous investments, like the CHIPS and Science Act, and to push for policies that favour domestic tech giants, all under the banner of competing with a foreign adversary. DeepSeek claimed its chatbot rivaled America's best, but was developed for a tiny fraction of the cost. While OpenAI spent $5 billion in 2024 alone, DeepSeek said it built its competing model for just $5.6 million. This was a direct challenge to the core belief in Silicon Valley that you need to spend billions to compete. But that low cost came with a hidden price. The app challenged the entire Silicon Valley playbook, but the situation soon took a darker turn. A senior US State Department official stated they understood DeepSeek has willingly provided support to China's military and intelligence operations. And this wasn't just a vague geopolitical concern. Security researchers who looked under the hood found alarming results. A report from Cisco, for example, found that DeepSeek failed to block a single harmful prompt thrown at it, whereas a model like OpenAI's GPT-4o blocked 86% of them. This means the model could be easily manipulated to generate dangerous or malicious content, making those state security concerns very real. But that's not the whole picture. 6 months later, the revolution has stalled. The initial shockwave has been called a red herring. The old model of bigger is better is back, with American tech giants plowing billions into data centers and chips. This shift back reveals a powerful business incentive. You see, the bigger is better model isn't just about performance. For the tech giants who also sell cloud computing services, promoting massive, power-hungry models creates a built-in customer base for their expensive data centers. It's a strategy that protects their revenue and creates incredibly high barriers to entry, making it almost impossible for smaller, more efficient players to compete at scale, regardless of how innovative their software is. And here's the final twist. Nvidia, the company that suffered that historic loss, has since rebounded, touching new highs to become the world's most valuable company. And DeepSeek, the challenger that shook the world, it's now reportedly facing delays on its next product. The reason? A shortage of high-end chips. And this is the ultimate lesson. DeepSeek's initial success suggested that brilliant software and algorithms could overcome hardware limitations. But its later struggles prove that at the cutting edge of AI, hardware is still king. This case demonstrates that US export controls on advanced chips are a genuine chokehold. No matter how efficient your software is, there's a point where you simply cannot advance without access to the best hardware. It highlights the fundamental bottleneck in AI development today, the physical chips themselves.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.